Adam, I'm not one of those who suggests that you buy gold because it might go from 2,700 bucks to 3,000 bucks. I'm one who suggests that you buy gold because I remember the decade of the 70s or the decade 2000 to 2010. In the first instance, the gold price went up 30-fold. In the second instance, the price of gold only went up sevenfold, which is to say, I don't buy it because I think I might enjoy a 15% move. I buy it because I'm afraid of a three or fourfold move, literally afraid of
Mhm.
a three or fourfold move.
Since ancient times, gold has been a reliable safeguard against economic uncertainty. In the 1970s, during stagflation, high inflation, and economic stagnation, gold rose from about $35 per ounce to over $850 per ounce by 1980, marking a 2,400% increase. Following the bursting of the dot-com bubble in 2000, while gold did not see dramatic gains, it started to rise as investors sought tangible assets, increasing from around $270 per ounce in 2001 to about $400 per ounce by 2004. During the 2008 global financial crisis, gold initially fell as investors sought liquidity, but rebounded sharply as central banks injected liquidity. By the end of 2008, gold prices rose from $850 per ounce to around $880 per ounce. In 2020, the COVID-19 pandemic caused significant economic disruptions, with gold reaching an all-time high of approximately $2,070 per ounce by August. With inflation rising in 2022, gold prices surged again, moving from $1,800 per ounce in early 2022 to over $2,000 per ounce in March, reflecting its continued role as a store of value. Rick Rule of Rule Investment Media strongly believes that anyone who doesn't own physical gold is missing a crucial opportunity. He views it as an essential asset that everyone should include in their portfolio. Rick Rule doesn't advocate buying gold for small price movements. Instead, he draws on his experience from previous decades, such as the 1970s and 2000 to 2010 periods. As we approach 2025, gold remains a compelling portfolio diversification and protection option. While a global investment bank anticipates that gold's rise to $3,000 per ounce may be delayed due to a more hawkish stance from the Federal Reserve, continued central bank purchases are expected to drive gold to new heights in the coming years. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Financial markets seem to be benefiting on a global basis from fairly easy credit, and the attempts in major markets to artificially reduce the interest rate cuts in the United States in a strong economy, I think are indicative of the fact that governments continue to favor an easy money policy. While this is good for capital markets in the present, my suspicion is that we'll have to pay the piper with higher rates of inflation in the future. One of the major things that we've seen with global capital markets in the last 2 months is investors on a global basis expressing continued confidence in the U.S. economy, anticipating at least nominally a stronger U.S. dollar relative to their own domestic occurrences, and a major flow of funds from global capital markets in the United States. Really amazed at the durability of the global economy given some challenges. It's been a very long time since we conspired to have a recession. I'm no economist, so I don't know that we need to have one, but I'm relieved that we've gone so long without a major economic disruption. I'm interested too that the conflict in Ukraine and the conflict in the Middle East, a spate of Islamist coups in Africa, haven't constrained investment demand and investment flows more than they have. Uh, I'm delighted, in fact, that there seems to be enough confidence in the world that despite some fairly obvious challenges, life goes on and people continue to prosper. That being said, I'm becoming perhaps even more cautious with my own funds, with my own money, than I have been in recent past. And I've been fairly cautious in the recent past. I would guess that my final comment probably relates to investor psychology, which is to say that there seems to be a concentration of capital in the biggest momentum names, things like the U.S. dollar, the largest and most liquid currency in the world, things like 10 or 12 stocks that dominate U.S. capital markets. I'm not sure that this continued strength but reduced breadth is healthy, but nobody asked me anyway, Adam. So I just observe it and report on it.
Investing in gold mining stocks can be highly rewarding when gold prices are expected to rise, as it often leads to better returns on stocks. Given the complexities and limitations of owning physical bullion, gold securities, such as stocks, funds, or options, offer a more convenient and practical option, especially for novice investors. Rick Rule believes that gold stocks are currently the most undervalued relative to the gold price he's ever seen. However, he warns that this sector is not suitable for everyone, as it demands thorough research and a high tolerance for risk. Fred Hickey, publisher of The High-Tech Strategist, has been a leading figure in the tech newsletter space since the early 1980s. While he has been notably bearish on the major AI stocks, believing they are overvalued and due for a correction, a topic for another time, Fred is currently most focused on gold and gold mining stocks. The rule also points out the increasing interest in gold from investors traditionally focused on other sectors, such as tech investors like Fred, signaling a shift in market sentiment towards gold. Now, let's redirect our attention to a video.
You pointed out a couple things. The long end of the yield curve is defying the Fed, which means that savers have a different expectation of inflation than the political class does.
Mm-hmm.
The second thing that's happening is that the delta between the energy industry's cost of capital and the rest of the economy's cost of capital is changing. Out of favor, oil and gas is still an out of favor industry. So insurance rates are going up, interest rates, particularly for non-investment grade issuers, but also prime rate issuers, is going up and availability is declining. And the equity cost of capital is going up. The discrepancy between the enterprise value of energy producers and the net present value of their cash flows at current commodity prices is at historic lows. So their equity cost of capital is the highest it's been in 50 years relative to the oil price. At the same time that debt is both less available and more expensive. And that will be a challenge to the industry. For me personally, as an investor, a lender to the energy business, a supplier of insurance to the energy business, and an equity investor in the energy business, the fact that their cost of capital is at an all-time relative high is attractive to me. But I can understand from a societal point of view how energy consumers wouldn't like that. Not so much in the US, but globally, the International Energy Agency suggests that the oil and gas business worldwide, including parastatal firms, is deferring about $1 billion a day in sustaining capital investments. You can do that for a little while, but this is a capital-intensive business. No capital, no business. You can see the long-term impact of that policy in places like Venezuela and Mexico, where the national oil companies have been piggy banks for politically expedient domestic spending programs, and where their ability to produce is as much as 75% reduced over 20 years, despite very large latent reserves. That the importance of the Trump election is Trump himself, but rather the fact that he represents the beginning of a change of sentiment among Americans, where less regulation, more prosperity, and less narrative is important. I'm not sure that Trump himself will be able to affect very much legislative change around the oil and gas business. But the de facto opposition, evidenced by Biden to things like the construction of liquefaction plants or interstate transmission, is gone. And I think that's a good thing. But I think more importantly, it reflects a changing will among the American people around economic development, around resource development. One needs to understand that drill, baby, drill is a function of geology. We've drilled a lot of our good locations in the last 5 years. It's a function of energy prices. Lower energy prices turns off the drilling tap very quickly. It's a function of the cost of capital, and it's also a function of the march of technology, not to mention local regulation.
Historical performance indicates that gold excels during periods of inflation, economic stagnation, and financial crises, making it a dependable hedge against uncertainty. Gold mining stocks, particularly when prices rise, can yield significant returns but carry added volatility and risk. As we enter 2025, a pivotal moment in American history, gold remains a key asset for financial stability in any portfolio. What advice would you give new investors considering gold as part of their portfolio? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.